This is NVIDIA's new DGX, and we call it DGX Spark.
In 2022, a single earnings report erased and created more wealth than the GDP of some nations. One company, once dismissed as a gaming chip manufacturer, became the central infrastructure of artificial intelligence. Its market value would cross $1 trillion, then two, then more. But this is not a story about technology. It is a story about capital, about how investors mispriced a future, about how patience quietly compounded, about how risk was misunderstood, and then suddenly repriced. This is the story of NVIDIA, and how it became the most important financial asset of the AI era.
Because at that time, I'm reading about books on how to start companies, and I'm trying to figure out, how to go raise money, and what's a venture capitalist, and how do you incorporate the company into those.
In the early 1990s, Silicon Valley was obsessed with software. Microsoft dominated. Intel controlled the CPU market. Capital flowed toward operating systems and productivity. Graphics were an afterthought. Three engineers saw something different. In 1993, Jensen Huang co-founded NVIDIA with a simple thesis. The future of computing would be visual. At the time, this was not an obvious bet. GPUs, graphics processing units, were niche components used primarily for video games. The margins were volatile. Competition was brutal. Hardware businesses died quickly. But NVIDIA's early insight was structural. Computing was shifting from sequential processing to parallel processing, and GPUs were designed to perform thousands of calculations simultaneously. That technical difference would become a financial asymmetry decades later. Investors didn't see it at first. In 1999, NVIDIA went public. Its valuation was modest. The company rode the gaming wave of the early 2000s, but Wall Street categorized it as cyclical, tied to console launches and PC upgrades. Capital treated NVIDIA like a consumer electronics company. It was not yet valued as infrastructure, and this misclassification created the first opportunity. The early 2000s were unforgiving. The dot-com crash destroyed capital. Semiconductor cycles were brutal. Inventory miscalculations could wipe out profits for entire quarters. NVIDIA faced intense competition from ATI, later acquired by AMD. Pricing wars compressed margins. Hardware was seen as replaceable. Investors learned a painful lesson. Revenue growth without pricing power is fragile. NVIDIA nearly made fatal mistakes. In 2008, it faced product defects and write-downs. The financial crisis tightened liquidity across markets. Capital retreated to safety. At that moment, NVIDIA could have doubled down on gaming. Instead, it made a decision that investors initially ignored. It began investing heavily in something called CUDA. CUDA was not a product consumers asked for. It was a developer platform that allowed programmers to use GPUs for general-purpose computation. In accounting terms, this was a cost center. In strategic terms, it was a moat under construction. R&D expenses increased. Margins compressed temporarily. Short-term investors questioned capital allocation. But long-term investors noticed something subtle. NVIDIA was shifting from selling chips to building an ecosystem. And ecosystems command different multiples.
Oh, this is the most advanced GPU in the world in production today. This is Hopper. This is Hopper. Hopper changed the world.
In 2012, a breakthrough occurred in the field of deep learning. Researchers training neural networks discovered that GPUs, originally built for gaming, dramatically accelerated AI model training. A moment of technical validation became a financial inflection point. The world did not notice immediately, but capital did. In 2017, cryptocurrency mining demand surged. GPUs became essential for mining Ethereum. Revenue spiked. Margins expanded. The stock accelerated. NVIDIA benefited, but it did not fully control the demand. Large cloud providers began buying GPUs not for gamers, but for data centers. NVIDIA's revenue mix began to change. Data center revenue, once negligible, started to grow. Gross margins expanded because enterprise customers value performance over price. This was the shift from discretionary consumer spending to mission-critical infrastructure spending. The market slowly began repricing NVIDIA. What changed was not just revenue, it was predictability. Gaming cycles are volatile. Cloud contracts are recurring. Investors reward recurring revenue with higher valuation multiples. The lesson? When a company transitions from product sales to platform dependency, its cost of capital declines. NVIDIA was no longer a graphics card company. It was becoming the computational backbone of AI research.
This is one GPU. Ladies and gentlemen, DGX GPU. You know?
The 2020s accelerated everything. As AI models grew larger, training required exponentially more compute. The appetite for GPUs surged. NVIDIA released increasingly powerful chips, A100, then H100, priced at tens of thousands of dollars per unit. This is where investor psychology shifted dramatically. Scarcity entered the equation. When demand exceeds supply in infrastructure markets, pricing power expands, margins widen, cash flow compounds. NVIDIA's free cash flow surged. Gross margins moved above 70% in some quarters, extraordinary for hardware. Capital began to rotate. Index funds were forced buyers as NVIDIA's market cap expanded. Active managers increased exposure to avoid underperformance. Retail investors followed momentum. This created a feedback loop. Rising earnings to higher stock price, to lower cost of capital, to more aggressive R&D, to stronger products, to more earnings. The company also made a critical strategic choice. It sold shovels, not gold. Unlike companies building AI applications, NVIDIA sold the infrastructure that everyone depended on. Cloud providers, startups, governments.
This is the NVLink spine. 2 miles of cables, 5,000 cables structured.
In every gold rush, the infrastructure providers often win more consistently than the prospectors. That insight alone reshaped portfolios worldwide.
It's called the DGX-1. It was the first version of everything that I've been talking about. 8 Volta GPUs connected with NVLink. A nonprofit startup in San Francisco was so delighted to see the computer. They said, "Can we have one?" And I thought, "Oh my gosh, we sold one." But then I discovered it was a nonprofit. But I put a DGX-1 in my car, and I drove it up to San Francisco, and the name of that company is OpenAI.
Companies like Microsoft, Amazon, and Google began purchasing NVIDIA GPUs at scale. AI was not a product. It was an arms race. Capital expenditure budgets ballooned. Cloud providers invested tens of billions into AI data centers. NVIDIA became a bottleneck supplier. When supply is constrained and demand is strategic, pricing power shifts decisively. NVIDIA's margins expanded significantly. Gross margins rose above traditional semiconductor norms. Free cash flow surged. The balance sheet strengthened. Investors who once valued NVIDIA like a cyclical hardware company began valuing it like a platform utility, a toll collector on AI infrastructure.
This is Hopper. Hopper changed the world. This is Blackwell.
In 2023, NVIDIA's quarterly guidance signaled demand far beyond consensus expectations. The stock surged dramatically in a single session, adding hundreds of billions in market value. This was not speculation alone. It was forward cash flow re-estimation. Analysts recalculated revenue trajectories. Institutional portfolios, underweight AI infrastructure, rebalanced aggressively. Passive funds, benchmarked to indices, mechanically bought more as market capitalization rose. Capital flows reinforced price. Price reinforced narrative. Narrative attracted more capital. But under the surface, concentration risk was building. A handful of hyperscalers accounted for a large share of revenue. If they slowed spending, earnings would be exposed.
Information is NVIDIA, a $4 trillion market cap, which no company's ever done, Jim.
NVIDIA did not stop at selling GPUs. It began offering full AI systems, integrated hardware, networking, and software. It acquired networking assets and optimized entire data center stacks. By moving up the stack, NVIDIA captured more value per deployment. Instead of a component supplier, it became a systems architect. This increased revenue per customer and deepened lock-in. Financially, this changed average selling prices and improved revenue visibility. Systems contracts are larger, more strategic, and harder to unwind. Lesson: vertical integration, when executed carefully, increases margin capture, but also increases operational complexity. Despite its strength, NVIDIA does not fabricate its own chips. It relies heavily on TSMC for advanced manufacturing. This introduces geopolitical and supply chain risk. Any disruption in Taiwan would impact global AI infrastructure. Investors often discount such risks during bull cycles, but they exist. Additionally, AI demand required massive capital expenditure by customers. If economic conditions tighten, hyperscalers may moderate spending. NVIDIA's valuation implicitly assumes sustained AI investment growth. Every premium multiple embeds expectation. Expectations create fragility. NVIDIA's stock has experienced multiple drawdowns exceeding 50% in its history. Long-term investors endured volatility that would have forced out leveraged positions. The lesson is psychological endurance. The same company that became an AI giant once appeared overvalued, cyclical, and exposed. Investors who understood its architectural moat, not just quarterly earnings, held through discomfort. Markets oscillate between underestimating and overestimating optionality. The edge lies in identifying structural advantages before consensus models them. Competitors began developing alternative AI accelerators. Startups raised billions. Hyperscalers designed in-house chips. But NVIDIA's moat is not only silicon performance. It is ecosystem depth. Thousands of developers, optimized libraries, enterprise integrations. These form switching friction. Capital defense is about more than R&D spending. It is about network entrenchment. NVIDIA reinvested aggressively in research, ensuring performance leadership while deepening software integration. Reinvestment reduced immediate distributable cash, but increased long-term durability. Investors had to accept lower near-term yield for higher structural dominance. Governments recognized AI as strategic infrastructure. Export controls reshaped chip flows. NVIDIA had to design modified chips for specific markets due to regulatory restrictions. This introduced policy risk. Revenue became subject not just to demand, but to geopolitics. When capital becomes strategic, it becomes regulated. Investors must price not only earnings, but also sovereign constraints. NVIDIA's ascent illustrates a broader shift. Compute is becoming foundational infrastructure, like electricity or railroads in prior eras. Investors learned that optionality hidden in niche products can compound for decades. Software ecosystems attached to hardware create durable moats. Windfall revenue must be reinvested wisely. Cycles punish impatience. Valuations expand when earnings durability changes, not merely when revenue grows. Today, NVIDIA sits at the intersection of AI ambition and capital intensity. It is profitable, dominant, and strategically positioned. But its valuation reflects enormous expectations about AI adoption, enterprise transformation, and sustained infrastructure spending. The market is no longer asking whether AI will scale. It is asking who will capture the economic surplus. NVIDIA has positioned itself as the toll collector, but toll collectors depend on traffic. The quiet lesson. The story of NVIDIA is not about hype. It is about architecture, patience, and disciplined capital allocation across decades. A company that nearly ran out of cash became central to the most significant computational shift of this century, not because it predicted the future perfectly, but because it built flexible infrastructure and funded ecosystems before the world demanded them. For investors, the enduring lesson is simple and difficult. Identify platforms masquerading as products. Endure volatility when structural advantages are intact. And remember that capital rewards those who see infrastructure before it becomes obvious. In markets, the greatest returns often emerge not from chasing trends, but from understanding the plumbing beneath them. NVIDIA did not invent artificial intelligence. It built the tools that made scale possible. And when scale arrived, capital followed. If this changed how you see money, subscribe. These documentaries are built for thinkers, not spectators. And if you're serious about mastering capital, watch the next video on your screen.